Welcome back. I'm Charles Lewis, the Austin area realtor who brings you topics and discussions that will help you make better decisions when you buy, sell, or invest in real estate. Today, I'm with my friend Chad Christian again from Security National Mortgage. Chad, thank you so much for taking the time to come.
Oh, it's always my pleasure. I love talking real estate and finance.
Today, we are going to talk about different financing options if you want to get into real estate investing. Now, Chad, one of the first things that people are going to encounter when they're investing in real estate is it may be slightly different on what's required to actually get approved for a loan.
You're absolutely right. Investment has quite a few different options than just trying to go conventional. So non-QM, you don't have to qualify for income. There's a lot of different aspects. The majority of the non-QM investment world.
Okay, before we go too much further, because this is partially kind of training, right?
Right.
QM.
Okay, so QM is conventional. So it's you have to qualify income.
Does it stand for something?
Yeah.
What does it stand for?
Qualified mortgage.
Qualified mortgage. So qualified mortgage is a conventional loan.
Yep.
Thank you. Okay.
Yeah. And non-QM is your more non-conventional financing.
Okay.
So no income, stated income. It's more tied towards the property and how much money you have that you can put down.
So translated, that would mean that if I had a house or a multifamily unit that produced rental income, I would be able to use that rental income to qualify for the loan.
Exactly. For your non-QM, which is one of them is a DSCR, debt consolidated ratio.
Okay.
It will take the market rent.
Okay.
And they'll like you to stay somewhere around 100%. So mortgage is $2,000. They'd like you to collect $2,000 or greater. Mm-hmm. They call that 100% for the ratio.
Correct. And a lot of folks who listen to the investing podcasts and things like that, that is what they call cash flow.
Exactly.
In other words, if you have more coming in than is going out, you have positive cash flow.
Exactly. And that helps with your down payment ratios, your LTV. Mm. So the closer you get to 100% or greater, the less money you have to put down because lower risk.
Correct.
And those loans, they would like them to be in an LLC or an entity.
Okay.
So you can finance multiple properties and they all have their own entity or LLC. It's a great program to, if you don't have a true way of proving your income, to acquire a bunch of properties the non-traditional way.
First of all, LLC, limited liability corporation, doesn't necessarily mean you have to have multiple owners, right? It could be an individual that owns the LLC.
Yep.
But instead of the title being in the name of the individual, it's in the name of this LLC.
Correct.
And with respect to financing, is it still dependent upon the individual's credit?
Yeah, especially if you're a first-time investor.
Okay.
You have to qualify.
So effectively, they would be a personal guarantor then?
Exactly.
Okay, so you're going to use your personal credit to assist in the qualification.
Yep.
How about the loan itself? Is the loan itself in the name of the LLC or the individual?
The LLC.
So the loan and the title would be in the name of the LLC.
Yep.
Certainly for another video specific to legal, right?
Right.
The LLC means that any kind of liability is limited to that property.
Exactly.
So in other words, if you had $1 million in the bank as an individual and there was some kind of lawsuit on the property, it would be limited to the property. So we've established that with this type of loan, which again for review, you call it what? A
DSCR.
DSCR.
Yep.
So the individual would apply.
Yep.
But the LLC would qualify based on the income produced by the property.
Correct.
Okay. A couple of further questions. It's relatively easy to verify rental income if it's an existing unit.
Yes.
Okay. What if it's new? That's what I'm getting to is what if it's new and you don't have any kind of rental history?
That's a great question. So if you don't have any rental history, the appraiser that goes out and assesses the property will come up with a market value. Let's say the appraiser goes out and the market value is, they're going to take the lesser of the two. So you have a lease agreement for $2,400 and market value is $2,200.
Okay.
They're going to use $2,200 as the market value for the rent in that area. For the purpose for qualifying, yep.
Okay. So what if the potential owner or the one interested in purchasing the unit was interested in increasing rent, usually with some type of renovation. So in other words, let's say it currently appraises at whatever, $1,500 a month, but they forecast that if I put some money in it, upgrade the kitchen, the bathroom, things like that, that I should be able to increase the rent to $1,800.
That's a great question. So if you're trying to buy an investment property that's vacant that you want to do renovations on, they have a different program besides DSCR.
Okay.
So that program would be your fix and flip, which is really what they call it, but fix and hold, fix and flip.
Okay.
So basically, you're going to buy a property for X amount of dollars. You're going to do X amount of renovation. They're going to give you a hard money loan for the property and for the renovations. And typically, they'll give you 80% of the ARV.
And that's after repair value.
Yeah, ARV is your after repaired value.
Okay.
And they're going to give you 80% of that and 100% of whatever the renovations cost.
Gotcha.
They'll give you that out in a draw. And then after the renovations are all done and you have a renter in there, you can refinance the hard money fix and flip loan into either a DSCR loan if you want to keep it investment, or you can go the conventional route, but a lot of investors go non-QM because it's tied to an entity. It's not on their credit.
With the rising interest rates on the consumer side for an individual and LLC loan, are you seeing a corresponding rise in the hard money rates?
They're 9, 10, 11, 12%.
Gotcha. Okay, so there is a spread, but is it as big of a spread as it used to be? In other words,
no.
Is it only a couple of interest points?
Yeah, it's only a couple points. Okay. It's not, you go 4 or 5% to 15%. Right. It's more 7, 8, 9%. Some will say that's high interest rates, but
I'll tell you one thing you might not be aware of. A hard money loan in this scenario is not going to be 30 years.
No.
It's going to be much shorter period.
Yep.
So even though that interest rate is higher, let's say it's 9 months. If you're only paying that higher rate for 9 months, it's not as bad as it might seem.
Right. They're very short-term loans. They're not set up for you to finance that property for 30 years. Okay. It's to get the money to acquire the property, and they usually typically close in 2-3 weeks, opposed to your 30, 45 days on a conventional type. They're usually something you find a property, they say, hey, we want either cash or hard money, and you close in 1, 2, 3 weeks, and you're in it, do the renovations, and then refinance it to something more permanent.
Either sell it, or if you want to hold it, you do. But let's do this is only because we haven't addressed it. Hard money. If somebody doesn't know, what does that mean exactly?
It's tied to the asset. So their whole investment is not as you as the individual that's financing the property. It's all more property driven. So
in other words, if I'm the hard money lender, and just examples, like let's say that the house appraises for $500, but I'm only loaning $400 on it. If I had to foreclose on that, there's a 100% guarantee that I'll get my money back. Yeah, they make sure to get as much money as they can up front, and make sure that at any point, if they're not able, the person that's taking out the hard money loan isn't able to repay the loan, that they'll be in a position to be able to sell the property. Have you ever seen interest only hard money on a?
Yeah, about 80% of them are interest only.
Really? Okay.
Yeah.
So in other words, is during the term of the renovation or the fixing in the fixing,
right,
is that the borrower is only going to pay the interest amount.
Correct.
So what that does is lower the amount of money that you're going to have to out of pocket
monthly.
The time of the renovation. And you said that if all the numbers add up, you can actually borrow the cost of doing the renovation, right?
Yeah.
Now, are those typically dispersed like?
Yeah, they're a draw process. Yeah. So as work's being done, they're withdrawing the money to the client to get the work done.
Have you seen any types of requirements for the minimum number of estimates on a renovation or anything
3.
like that?
They need a minimum of 3.
So you do have to get the estimates prior to submitting the loan if you're going to bundle it all together.
Oh, absolutely, yeah. They'll want a whole breakdown of the work being done. They'll need estimates for all the work being done from a contractor, and they'll need to have the permits and how much permits are going to cost and time frames and things like that.
Do they put requirements on? Does it have to be like a, quote, licensed contractor?
Yeah, they have to be a licensed contractor.
They have to have a license. and submit a written.
Yeah, it couldn't be your neighbor saying that he's going to do the work.
Exactly.
It has to be a contractor.
Well, I mean, there are a lot of folks.
If your neighbor's a contractor, he'll have to be licensed.
Correct.
Yeah.
Right. Okay. Well, this has been very helpful. I know I've learned a lot, and I'm sure folks out here have as well. Before we wrap up, do you have any other thoughts?
No, anybody that has any mortgage questions or investment-related mortgage questions, I'd be happy to answer them.
If you have any ideas on what we might do to improve these videos or topics that we might cover, don't hesitate to reach out and let us know. All of our contact information is in the video description. Once again, thanks for watching, and let's make your real estate dreams come true.